Hello everyone, welcome back to our economic survey and budget explanation series. So we have already completed 3 videos. In the previous 3 videos, we have seen the preface of economic survey and chapter 1 of economic survey and chapter 2 of economic survey and the relevant portions from budget and 16th finance commission. So let us continue with the economic survey chapter 3. Okay, in the previous class, I have shown you some previous year questions because in previous class we have seen fiscal policy. Chapter 2 is about fiscal policy and fiscal developments. So, how previous year questions are being asked by UPSC we have seen. But there are 2 important questions from last year. This I could not show you in the previous class. These 2 questions, they are also about fiscal deficit, primary deficit, etc. Questions you will read, these topics you will read in theory. You don't have to read economic survey to understand this concept. But the difference between other questions and these 2 questions is that these are application based. You can see here, they are giving you a situation and they are asking you the what is primary deficit in this situation, what is fiscal deficit in this situation. So here you are expected to apply your theoretical knowledge and arrive at the answer. So this kind of application usually we will not read in theory part. The static standard books we read. So when you get to know these kind of application, not just for fiscal deficit or this thing, real world application we will read in documents such as economic survey. When you read documents like economic survey, budget only, then you will understand the real life applications of all the static concepts you are reading in your standard books. Okay, whether it is Ramesh Singh or Vivek Singh, whatever the book you are reading for economy, or even for any other subjects, the application will be usually you will be understanding through these kind of documents only. Okay, just I want to make that point. Then previous class is about fiscal policy and previous chapter is about fiscal policy. This chapter is about monetary policy. Okay, fiscal policy management and monetary policy management. So you need to understand the difference. Fiscal policy, we know, is about the management of revenues and expenditures of the government. Okay, it is done by the government. On the other hand, monetary policy is managed by central bank. Monetary policy management is done by the central bank and it is done usually through changing the interest rates or money supply. Money supply in the economy. How much money is in the hands of Indians? By varying the amount, RBI manages our monetary policy. Targets may be same. Both will have the same targets of stabilizing the macroeconomic variables, macroeconomic fundamentals, price levels in the country, inflation, GDP growth rate, employment growth rate. So same targets but different mediums. They will use fiscal medium, which is revenues like taxes, okay, expenditure like capital expenditure, etc. They will use monetary policy tools. Okay, I will show you what are monetary policy tools. So why it is called monetary management or monetary policy management? Why not monetary policy? It's not a static thing, because it is not a static thing. It is very dynamic. Economy is very dynamic, any economy, and it faces many challenges. Continuously it faces challenges. Like in the previous chapters we have seen how the world is very uncertain, how it is facing many kinds of threats, actual wars, trade wars, okay, tariff wars, export restrictions. So economy is always in a constant dynamic situation. So based on the domestic and international developments, you need to accordingly adjust your variables. You need to manage your monetary policy. You need to manage your fiscal policy. Okay, so that is why we call it monetary policy management. It's not a static thing, it is a dynamic thing. So this background takes us to the chapter 3. See the title, monetary management. Okay, now you have understood why it is called monetary management. And financial intermediation. What is financial intermediation? Conversion of savings into investment. Okay, I will explain more in the later slides. Okay, see the theme. Again, like every chapter, if I have to summarize the entire chapter into one sentence, this will be it. Balancing growth with stability in an era of global uncertainty. So throughout economic survey, we are talking about how uncertain, unpredictable, unsafe the world is and how India is navigating the situation. Every chapter we are seeing the same, just the dimensions are changing. Previous class we have seen fiscal developments. Okay, now we are seeing monetary policy developments. Okay, so how India is balancing growth and stability in this world using monetary policy, that is what we are going to see. Okay, from reactive to proactive anticipatory governance. So they are also talking about changing the governance in this monetary management and financial intermediation. Okay, we will see what is it. So you can break this title into three parts. First one, they are talking about monetary management. We already know what is monetary policy management. Okay. Then they are talking about financial intermediation. What is financial intermediation? So some people will have surplus, whether it is rich people or households, people, everybody, most people will have some surplus money based on their ability. Like imagine if I have some money, I have this habit of gathering money, storing money. So for my future, I keep a piggy bank or kiddie bank in my house. I deposit my every 10 rupees per day for future. Okay, I keep on saving for future. This is my savings for the future. But the problem with this kind of simple saving is that there is a lot of requirement for money in the economy. Many investors, many businessmen, many corporates, many individuals also, they are looking for money to start businesses, to put into new investment, to generate more money. So if I give some 1 lakh at a 10% interest rate, he will create some 2 lakhs, he will pay my 1 lakh with interest back and he will keep the remaining money. So there are many people having surplus, there are many people and institutions having requirement of money, they want money. So how to transfer this savings into this investment? This is done by something called financial institutions. This is what we call financial intermediation. So conversion of normal money in its normal form we call money or cash. When you convert these savings, excess money, savings into investment, it is called finance. Okay, so this is the financial system. All the institutions, banks, NBFCs, okay, RBI, all of these institutions involved in this process are the together called financial system. This whole system, this processes, institutions, all of them together called financial system. Okay, so they are talking about this financial intermediation. The process is financial intermediation. They are mediating between the people who are having surplus, who are in the need of the money. Okay, so we are talking about this financial intermediation. Then the third one is regulatory refinement. What is regulatory refinement? So any sector needs to be regulated. We cannot leave any system like that because it will be a disadvantage to the vulnerable people. Okay, so in every society there will be some sections with advantage, there will be some sections with disadvantage. So government has this need to regulate things, okay, so that things will not go out of hand and some people will not feel disadvantaged. So this financial system also needs to be regulated, and this financial system usually contains many components like this. There will be banks, banking, there is banking component, banking system, and there is something called pensions. Okay, people deposit money, people store this money for the future. Okay, people invest money for the future, it is pension. Then there is insurance for any kind of in case scenarios, anything if wrong, anything if goes wrong, for those kind of cases like accidents or death of an important family member, death of the breadwinner, etc. So in those cases we are keeping insurance. Okay, and there are many kinds of systems this way. Okay, so there is securities market. So other than banks, some people may want to give loan, we call it bonds. Okay, or some people want to exchange investments. Today I own some part of a company which I call shares. Tomorrow I want to exchange shares with someone, so it is called exchange of shares or stocks, exchange of stocks, which is done on stock exchange. So there is securities market. All of these together are called securities. We will see more in depth. Okay, so there are various kinds of instruments, various kinds of mechanisms in this financial system. So based on these various segments, we have different regulators in the financial system. So financial system consists of various regulators, okay, like RBI, SEBI, okay, Insurance Regulatory Development Authority of India, okay, PFRDI, okay, then there is insolvency and bankruptcy code. So if anyone has taken loan or money and they are not paying back, so there should be a grievance redressal mechanism. So there is an IBC Act. So this is the ecosystem of financial intermediation in India. Okay, this is the financial system of India. We have various regulators. This is the static part I have told briefly so that you can understand what is coming next. Okay, so what we are discussing here. So there is also a discussion on regulatory refinement. So all these regulators, RBI, SEBI, PFR, okay, PFRD, etc. So all of these regulators, till now they are taking heavy hand approach. If anyone is doing wrong, I will punish very heavily. So we have seen similar one in this previous chapter also, where these tax authorities are usually taking very heavy approach. Now they are taking something called nudge approach. Okay, nudge approach. They are nudging people before punishing them. They are giving a decent opportunity to people to resolve their grievance before punishing them. Okay, so instead of heavy-handed approach, we are taking a lenient approach. We are facilitating financial intermediation. We are facilitating more businesses. We are facilitating more conversion of savings into investment. Okay, we are enabling things. We are not obstructing things. Okay, so regulatory refinement. Regulation also needs a refinement here. Okay, instead of harsh mechanisms, we are going through principle based mechanisms. Okay, principle based governance. So no random, biased or subjective interpretation. There will be set rules so that everyone can understand what is going on the system. Based on the rules, everything will go on. Okay, so this is the regulatory refinement they are talking about. More and more we will see in the later slides. Okay, so now you know all of this, what this chapter is talking about. It is also talking about balancing growth with stability. So like, take for example, banks gives loans. Now what is the appropriate amount of loans bank can give? If a bank keeps on giving loans to everyone who is asking, not everyone will repay. So we think the more loans bank gives, the more profit bank earns back, and the more will be the growth. But it is not true. Beyond a certain point, growth becomes very harmful. It will have other consequences. If bank keeps on giving unlimited number of loans, some of them will not repay and bank will go into crisis. So there will be a middle point. At the same time, the opposite end, stability. If bank is worried too much, if I give loan and what will happen if he does not repay, I will go into more losses, I have to close my bank. So if banks are in a constant worry, they prefer stability over growth, then they will be too much hesitant to give loans. Without loans, people cannot invest, people cannot earn more. We know investment gives more returns in the future. So there will be no growth at all. So we need a perfect balance between growth and stability. Same for anything. Take for artificial intelligence. Many companies across the world, they are investing so much into the artificial intelligence. We are calling it AI bubble. Okay. Nowadays there is so much discussion about AI bubbles. What is AI bubbles? Too much of investment. If you see few years back, we have heard something called cryptocurrency bubbles. Too many people are investing too much amount in the cryptocurrencies. Whether they worth that much, will the value stay that way? No one knows. If they fall, it is called bursting of the bubble. So many companies, OpenAI, Google, Microsoft, okay, Anthropic, many companies across the world, they are investing so high amount, so heavy amount into the artificial intelligence, expecting that they are not earning any profits right now. They are only investing, but they are expecting in future they will earn more than the amount they are investing right now. So a bubble keeps on growing. The amount investing is too high. What if they will not get returns they are expecting right now? What if in future something happens, like there is global war and suddenly the world has gone into crisis? So we cannot use artificial intelligence like we are using right now. Our people do not have the ability to pay, and AI bubble will burst. Okay, so you have to balance growth with stability. Okay, this is same for anything. Now in the financial system, there is a challenge of balancing growth with the stability. Okay, so too much growth will lead to asset bubbles and crisis. Too much stability will squeeze the credit. Banks will be, financial institution will be too hesitant to give the loans. Okay, there is a need to balance this growth with stability. This is the current dilemma. Okay, how we are balancing this dilemma, we have to see. Same with anything, whether it is A or normal loans, anything, we have to balance between both. Okay. Now the global situation. So this is like basic point for all the chapters we are seeing. So the world is very uncertain. We are seeing rise of geopolitics. We are seeing tariff wars, trade wars, etc. So the world is very in a uncertain phase. There is a lot of policy uncertainty. No one knows what will happen. I don't know. I thought I could invest in Venezuela 2 months back, but now Venezuela is controlled by USA. I thought I can invest in, let's say, a US investor in last year this time, he thought it is safe to invest in India. But then Trump imposed 50% tariffs with India. Okay. So somebody thought it is safe to invest in China. Then again, Trump has given an order to stop exports, semiconductor exports to USA, to China. Okay. So scenario keeps on changing. There is a lot of policy uncertainty. Okay. So there will be impact on this. Now this economic survey says, sir, you need to understand two things. Here, there are two sectors. See, actually, there is a question on last year. There is a question in last year prelims based on this. But most aspirant does not know this. It was discussed in these documents like economic survey, etc. But in standard books, this is not discussed. Till last year, no standard books have this kind of thing. See, there are two things. One is real sector, another one is financial sector. The sector we are talking about. What is real sector? Where things are actually produced, like agriculture. Okay. In agriculture, you will put seeds, you will get crops, you will harvest crops. This is actual, real production. You are creating a resource. Same with manufacturing. Same with services also. There is no service like, take this class. There is no video on this chapter 3 before, but right now I am creating it. It is a part of service sector. So there is a real sector where all the sectors where real products are produced, it is called real sector. Now there is something called financial sector where there is no new creation, only intermediation, changing one form to another form. So whatever the savings I am producing from this, they are being converted to another sector in this. Okay, a farmer gets some profit and he puts that money in some financial institution like bank or something. Then another company which is in manufacturing, it will take the money and it will establish a new plant. So they will produce. So we are seeing two sectors, real sector and financial sector. You can see here this previous year question UPSC has asked. So they are asking which of the following activities constitute real sector in the economy. So farmers harvesting their crops, yes, of course. Textile mills converting raw cotton into fabrics, yes, of course, it is manufacturing. A commercial bank lending money to a trading company, no, it is the financial sector. A corporate body issuing rupee denominated bond overseas, no, again it is financial sector. Okay, so this question was asked last year. So the economic survey says something happening in the world, like this uncertainty happening in the world, this uncertain things, policy uncertainties happening in the world. First we will feel the impact in the economic sector, financial sector. We will feel the impact in the financial sector because people here, the people with the savings, they are looking around thinking which is safe place for me to invest my money and get more returns. Banks are thinking what is the appropriate amount of loans I can give in this kind of scenario. Okay, so in financial sector there is so much of speculation going on constantly. So anything going wrong in the world, first we will see impact in this. The impact of this sector we will feel in real sector. So banks have money, but because let's say financial condition of the country is not good, economic condition of the country is not good, country is not seeing good growth rates, people are not getting much income, so banks will be hesitant to give loans. So when they do not get loan, people cannot invest, the real sector will not grow. So this says the impact of uncertainties of the world, first we will feel in the financial sector, then it will transmit to real sector through different channels. What are these transmission channels? Firms delay investment because they might not get any returns, so they will wait and watch. Okay, they might not get proper credit, even if they get, they will get at very high cost. Okay, so credit spreads widen. Credit spreads means spread, like say, if I am buying an Indian bond, we have seen in previous class, an example given by economic survey is that the yield on, interest rate, forget this. Let's say Indian government wants some money and a Chinese person have that money. So India government will issue some bond or something, some paper, find some security, and he will give me money to Indian government, and Indian government will give that paper as security, as proof, that agreement. So let's say the interest rate agreed is 10%. Unless Indian government pays 10% of the principal amount as interest every year, he is not willing to give money to India, because he sees some risks with India, so he is asking very high interest rate. Now US government needs some money. US government is also looking for some investors. So the same Chinese person, if US government wants to take a loan, he will give the money, he will take the bond, but the interest he is expecting is only 6%, because he is trusting US more. He is willing to accept a bond from US, a security from US at lesser interest rate, because he thinks US as a country is more stable. Let's say the period of this bond is 30 years. For 30 years, we have to pay interest every year. At the end of the 30th year, the principal amount has to be given back. This is the agreement. So 30 years from today, this is 2026, I should know what will be the situation in 2056. I am betting on situation of India in 2056. No one knows what will happen to India's situation in 2056. Maybe China may attack us, maybe US may attack us, US may turn an enemy, maybe Russia may become an enemy in future. So no one knows in future, so everybody judges different countries, and we already know credit rating agencies will give credit ratings to different countries based on investment worthiness. Because US is stable, it is the largest country in terms of GDP, it is the most powerful country in terms of defense. So he is willing to bet more on USA, so he is willing to accept less interest rate. So the difference between these two is spread. Okay, spread of Indian bond with the US bond is 4%. Okay, this is called spread. Now when there is uncertainty, now the same person who is previously asking 10%, now he will say, I will not give loan unless you give me 12%. So the spread increased. When there is uncertainty, the spread has increased to 6%. Okay, so this is the credit spreads we are talking about. Okay, so when there is uncertainty, cost of finance will increase. I have to pay more interest rate. Okay, credit spreads widen. Okay, and market correction, asset bubbles burst. So people, when they will not get return on something they are betting, they are investing for so long, finally it may go into crisis. Okay, debt crisis. So governments will be in crisis when the world is uncertain, and governments borrow too much. When governments borrow too much, there will be not enough credit left for private companies. Okay, so they will crowd out private investment. So economic survey is also talking about AI and technology. How it is first talking about the background, the kind of world we are living in, uncertain world, and also a technology intensive world. We are in a technology intensive world. Okay, we are being currently dominated by many kinds of technologies, artificial intelligence, various kinds of cryptocurrencies, etc. And the economic survey is saying these are two-edged swords. First we are knowing the context, situation, then we are knowing what India is doing. Okay, so as I told, a bubble is going on right now. A bubble is going on. Many of the companies earning profits or having high valuation on stock exchange is basically based on AI only. Okay, most people are betting and investing. Most investors are investing in artificial intelligence. So if there are 100 investors, there are many sectors, many companies going on across the world. They can invest in farming, they can invest in real estate, they can invest in pensions, they can invest in insurance, etc. But most people are, as of now, willing to invest in artificial intelligence. So this S&P, we know it is a global agency. So in its index, there are companies. So most of the companies which are having high valuation are artificial intelligence. Okay, and these artificial intelligence models are creating herding behavior. Let's say there are 10 stocks or 5 stocks, for example, Infosys, Wipro, okay, then there is Geo, okay, and then there is Adani Enterprises. There are 10 companies, just assume there are some companies like this. So because there is a rise in artificial intelligence, I will go to ChatGPT. I will ask ChatGPT which is a good stock to invest. ChatGPT will say Geo. Then another person will come, again he will ask ChatGPT. ChatGPT will again tell Geo to the person. Another third person somewhere in another state, he will ask ChatGPT. Again ChatGPT will say Geo, because this ChatGPT is having the similar algorithm elsewhere. Okay, almost all of the artificial intelligence are having some kind of similar algorithm. It depends on the data they are fed. So everybody is investing in Geo just because ChatGPT is telling them so. So this is how AI is creating herding behavior. Everyone is doing the same thing because of artificial intelligence algorithm. You can understand. See, the more you watch some kind of videos, Instagram or YouTube algorithm promotes similar kinds of videos. So algorithm works in repetitive patterns. Okay. So this is how artificial intelligence is dangerous. They are creating a particular type of undesirable behavior in financial markets. Okay. And some bubbles we have already seen, like cryptocurrencies. Cryptocurrencies have seen so much growth. In last few years, they are falling too suddenly, too severely. Okay. So there is a mention of a crypto coin called Stablecoin, how it has fallen suddenly. Okay. The problem is with this kind of bubbles, there will be a spillover risk. So if I take some loan from bank and I invest in some cryptocurrency or artificial intelligence or something, now suddenly it has fallen. Now I cannot pay my loan back to the bank. Now bank will go into the crisis. So the bubble of these technology bubbles can create an impact in the financial system also. Okay. Now we are talking about Indian context. So in this kind of world, how is India performing? How we are managing our monetary policy? Okay. So banking sector is resurgent. Okay. So one good news, economic service telling us, sir, few years back, we used to have so much crisis. The non-performing assets, I have told you in previous class also, the bad loans, among the loans given by the bank, those loans which are not paid back for more than 90 days are bad loans or NPS. NPS have touched 9%, 11% of the loans given previously. But now they have fallen to, gross NPS have fallen to 2.2%. Okay, that means almost 97.8% of the loans banks are giving, they are being paid back. So this is a good thing. Health of the banking system is good. Okay. Then the twin balance sheet crisis was over. So when these NPS are at a high, we have a problem called twin balance sheet problem. What is twin balance sheet problem? Balance sheet means almost like a budget. How government is managing its revenues and expenditures. Companies manage their assets and liabilities. So there is a company A which has some assets like its buildings, its computers, etc. And it has some liabilities. It has taken a bank loan. It has to pay salaries to the people. So it has some assets and some liabilities. It is its balance sheet. Then you have a bank which has given a loan to the company, this company A, So this loan given is an asset for the bank because bank has a right to claim it in the future. And bank may have other liabilities. So every company, every agency will have the statement of liabilities and assets. So there is a balance sheet of the bank, there is a balance sheet of the companies. When companies does not perform properly, so I have taken loan and I have invested in something but it did not work out, then my balance sheet will be poor. My balance sheet will not look good because I will have too many liabilities, too less assets. When I could not pay back the loan, what happens to the bank? Suddenly bank will lose its asset because I am not paying back the loan. So bank's assets will also fall, bank liabilities will also increase because bank liabilities means how bank will give this money. Bank will take from the common man in the form of deposits. It is a liability for the bank, and bank is giving me at an extra rate, higher interest rate. So its asset has gone but its liability is remaining. So bank's balance sheet will also go worse. So twin balance sheet, both banks and corporates, balance sheets of both are worsening few years back. So this was the twin balance sheet problem, but luckily it was now over. Okay. So to resolve the issues in the banking system, like let's say 4 banks have given loan to one particular person, like Vijay Mallya or Nirav Modi, and he did not pay any of them back. He has left the country. But there is a company of him which is valuing, let's say 5,000 crore. He has taken 10,000 crore, but the remaining assets of this person in India is 5,000 crore. All banks together has given 10,000 crore. Now how these banks will distribute among them this 5,000 crore? Who will get most amount? Who will get the least amount? How to recover this? What is the process? So this all will be this insolvency, bankruptcy. Bankruptcy means not being able to pay back. How to resolve this bankruptcy? How to solve this? This is given in this IBC Act, okay, Insolvency and Bankruptcy Act. After this introduction of Act, situation has improved and our situation, our ratings also improved, okay. Insolvency also the same S&P, we are talking about. It also gives rating for the insolvency regime. Insolvency regime of a country. How the insolvency and bankruptcy system of a country is working. Because investors will give loans, these creditors will give loans, and some people invest the loan they have taken. So if there is something have gone wrong, these people, creditors who have given the loan, they should get the money back. System should support creditors. Otherwise people will be very hesitant to give loans. Financial system will not work. Savings will not turn into investment. So our insolvency and bankruptcy system should be proper. Resolution system should be proper. Every country will have this. Now these global agencies will also rate this system also. They will rate this system also. Because India has implemented this IBC and our system is overall is improving, we have also seen a increase in our insolvency regime rating. So it will give like group A, which is very good, group B, which is okay, group B, which is okay. If it puts in group C, it's kind of bad, okay, it's kind of bad. Just like for investment, it has given AA plus, AA minus, BBB, BBB minus, etc. For insolvency and credit regime, they are giving group C, group B, group A. So previously we were group C, now S&P has upgraded our rating into group B, okay. This is also a recent current affair. So public sector banks also, they were in crisis because of the twin balance sheet problem, but now government has infused capital into them. So it has given some money to recover and now they have recovered, okay. So bank overall is performing good. So our NPAs, gross NPAs, net NPAs, etc., they are falling, okay. Now there is good capital. There is something called capital adequacy ratio, okay. Capital to risk assets, risk weighted assets ratio. You will read in static portion, okay. In the banking system you will read about it. Simply put, you have to simply say the amount of capital banks have to protect it from losses. Capital means money. How much money it is having without giving loans. If all the money is given as loans, there is no leftover capital. There is not adequate capital in the system. Then bank will be facing losses if they are not repaying back. So some amount has to be kept separately without giving loans, so that to have adequate capital resources. So this is called capital adequacy ratio or CRAR. Now it should be high. Theoretically, the more it is, the good it is for a bank. Now it is improving to 7.2%, so it is also good. So our overall banking system is performing very nicely. Then comes financial deepening. Deepening the financial system, that means more amount of people who are saving the money, savers needs to be brought into the financial system. More number of investors to be brought into the financial system. More number of institutions to be developed, more number of networks to be developed. Improving the size and complexity, activity, intensity of the financial system is the financial deepening. Okay. So if you see, first you should know something called securities market. To understand this, just a brief background I am telling you. So what is securities market? SEBI regulates it. So there are something called securities, okay, where the securities are traded are securities market. So securities are instruments tradable in the market. Like if bank has given a loan to you, you cannot trade it. If I take a loan from the bank, there is no way I can transfer this loan to someone. Only I have to pay or I have to close the loan. If I want to switch from it, I have to close the loan. Otherwise, there is no other way. Okay, I cannot give this loan. I cannot transfer this loan to someone else's name. It is not tradable. On the other hand, there are some things like stocks, shares in a company. If Jio says, I need some 1 crore investment in my company, that Mr. Ambani has brought 99 crore. He has 99 crore. He just need 1 more crore. I will say, sir, I will give you this 1 crore. So he will give me a paper representing that, showing that I have given that 1 crore indeed. But in this situation, I can trade it. I can just exchange the certificate with someone else in the same way he has exchanged this with me. It is trading of stocks. We will do it on exchange, stock exchange. So those things which you can trade are securities. So in securities market, broadly you will deal about, okay, equity, which is the ownership in a company. Equity means ownership in a company, ownership rights in a company in returns for money. Then you will have debt. Debt means loans, okay, just giving loan. I am not a owner. If you are a owner, if company earns too much, you will earn too much. You will share profits. If company gets losses, you will also bear losses. But if you give a loan to someone else, you are not linked to profits or losses. If company earning too much, you will not get anything. Company is facing losses, still you will not get affected. You will get your money plus interest. Okay, this is debt. Then there is something called derivatives. Okay, I am not explaining static here. I am just telling whatever you require. Now in this market, this is further divided into two. This all of the securities you can divide it into two markets. One is capital market. The same things, okay, capital market. Another one is money market. So basically all of these are agreement. I will have ownership. For how long you will have ownership? I will give you loan. What is the duration of the loan? So these are related to tenure, terms. So if the time period is less than 1 year, it comes under money market. So all the instruments, financial instruments which are dealing with less than 1 year are a part of money market. Like there are something called treasury bills. Okay. Then all the financial instruments which are more than 1 year comes under capital market. Okay. So ownership, there is no 1 year, 2 year. Equity is completely under capital market. Debts, loans you will be giving. Usually you can clearly say, I am giving you loan only for 6 months. If I am giving money for someone only for 6 months, it's under money market. If I am giving loan to someone for like 10-20 years, it is part of the capital market. Okay. So same instruments belongs to capital market or money market, you have to see. So now you have understood capital market. Here it deals with equity, debt more than 1 year and derivatives, etc. This is capital market. Hope you have understood. Everything is security market. Now Money market is the thing usually deals with debt, only loans, because there is no concept like ownership for 6 months. So usually debt is for more than less than 1 year. Okay. Then whether your debt is more than 1 year or less than 1 year, this debt you can classify into two. One is government debt. Okay. Another one is non-government debt or corporate debt. That means whether I give loan for 6 months, 1 year or 10 years, whatever the duration, that particular loan I can give either to government. Government needs money. Government wants to build roads, bridges, networks, etc. Solar parks. Or some private company may want it. Private individual may want it. Okay. So corporate debt versus government debt. Okay. So hope you have understood this. Only very briefly I have discussed. Okay. So now you will understand. Now everything will make sense. See, first they are talking about capital markets. First they are talking about capital markets. So in the capital markets, household shifting from deposits to markets. So households are entering these capital markets. Previously household used to prefer only bank deposits or saving within homes, etc. But now many households are coming to the capital markets. What that mean? You can know this. Many people are taking, like in simple phone apps you can invest. Like there is an app called Angel One. There is an app called Grow. Okay, so there are many apps. Using your phone from your bank account, you can open a demat account. You can buy stocks of the company in a few minutes. Now because of the technology it is possible. How this is changing? Households which have previously preferred savings like bank deposits, post office accounts, buying gold, etc. Now they are preferring capital markets. They want ownerships, because with ownership, if company is performing good, you will also get amount, extra amount. Okay. Then DI means domestic institutional investor. Institutional investor means companies, not individuals. Okay, large companies or government institutions, etc. Other than individuals are called institutional investors. Institutional investors. Now, institutional investors are two types. One is domestic institutional investors, or they can be from outside of India, who are foreign institutional investors. So when you depend on foreign investors, the problem is, we have seen in the previous class also, if something goes wrong, they will go back. So we have two types of foreign investment: FDI, FPI, foreign direct investment, foreign portfolio investment, FPI. FPI means coming only for temporary gains. Something happens across the world, Trump will announce some tariffs, suddenly all the people will take their capital, all their investment from India and go away and invest in USA. So foreign capital is vulnerable to many external situations. On the other hand, if you believe in the investment of domestic investors, people who are living in India, they are usually not affected by the external conditions. They are safe. Now previously, till now, our foreign institutional investors share is higher. Okay, share is higher in our capital markets. They are the one investing more in the capital markets. You can see here domestic investors preferring other mechanisms like bank deposits, gold, etc. But now the situation is changing. Now domestic institutional investors are more than foreign investors. So this is a good thing, because domestic investors are more trustworthy, more stable than foreign investors. So our financial market is achieving more stability. Then coming to debt markets. Debt markets. So previously I have talked about this particular capital market. Now I am talking about debt market, which may contain instruments more than 1 year or less than 1 year. Okay. So debt market, corporate bond market, okay, of corporate is increasing. Okay. So it is 16% So it is 16%, but there is more room to grow here also. Okay, we have to increase this. Okay, it is very low. It is increasing to 16%, but it is still low. So economic services, there is more room to grow here. Now the challenge, another challenge here is that not only it is not seeing enough growth, another challenge is that all the debt bonds given, whatever the loans being available in the capital market, debts are available in the capital market, they are only going to those investors who are having high rating. Okay, so we already know AAA rating means very high. So those people who are having AA or AA minus, very high ratings, they are only the ones getting the bonds, debts, etc. If I am a new investor, I may be a sincere person, but if I am a new one, I will not have good rating and I will not get enough bonds or debts from the market. Okay, because market is hesitant, it is not yet full developed. Then we already know we have established something called Gift City in Gujarat. There is a international financial institution, international financial services institution in this. Okay, so we will see to this external aspect. So among the all the international financial services center, international financial services, that means till now whatever we are talking about this financial intermediation, we are talking within India. When you do this financial intermediation between countries across the globe, it is international financial services. The place which is providing this, the institution which is providing this is International Financial Services Center. Now what is Gift City? Gift City is a international financial center. So previously, before Gift City, let's say I want to take a debt instrument, take a bond from a US person, I have to go to various other IFSCs like Singapore, UK, Dubai, etc. In India, there is no International Financial Service Center. So only I can buy only local ones, Indian ones. But now because there is an International Financial Service Center in this Gift City, now within India we can do these activities. What will be the difference? If a International Financial Service Center is outside of India, the taxes earning from those transactions will go to that particular country, Singapore or UAE or UK, whichever country it is placed in. Now it is in India, so transactions will go on. There will be buyers, there will be sellers, there will be savers, there will be investors. But in this transaction, we will earn different kinds of taxes. Okay. So it was recently established. Right now it is 43rd, ranked 43rd across the world. So now economic service talking about the general credit in the economy, the amount of loans, okay, the amount of money is available for investing from these financial institutions. So overall credit growth rate is good. Okay, so we are seeing 14.5% growth rate from the previous financial year to this financial year. So growth rate is good. And MSMEs, which are micro, small, medium enterprises, these MSMEs are very important because they are the smaller ones, they give more employment. Large corporations, they will earn more profits, but the amount will, the employment will be lesser, and the amounts, salaries go to the people will be lesser. There are many number of MSMEs, common people are more closer to the MSMEs. So MSMEs growth is good. And we are seeing a 21.8% credit growth to the MSMEs. So this is a very good news. Then personal loans also increasing, driven by strong gold loans. So personal loans also increasing, and they are mostly gold loans. Loans are various types, house loan, gold loan. Okay, so here we are seeing a surge in gold loans. So we already know financial sector is deepening, particularly corporate financial sector, that means other than government, is more deepening. Okay, so here you are seeing previously large firms, previously they used to buy mostly from bank. So all the companies which require investment, they are mostly borrowing from banks, but now they are raising bonds from markets. Okay, capital markets. So it is a good thing. So we already know debt market is a challenge. It is skewed to only those agencies which are having high ratings. Okay, and these MSMEs, they may be getting good credit from the banks, but from bond market still they are excluded. Okay, they are getting good credit, but it is mostly from banks, not from markets. So this is just a repetition. So this deepening of capital market will actually reduce our over reliance on banking. Currently we are over among the financial system. Banks are playing too much role. There are many other financial institutions, non-banking financial institutions, stock exchange, etc. So capital markets, etc. So we are right now heavily reliant on banking, but with the financial deepening, now the reliance on banking is reducing. So this corporate bond market is currently only 16%. This is actually low when you compare with other countries like OECD countries like France, etc. France, Germany, etc. developed countries, which is having almost 80%. If you calculate the value of their bond market, it is almost 80% of their GDP. But for India, it is only 16% of India's GDP. So we have so much room to improve. That is what in previous slide economic survey is saying. Okay. Now we already know one concern of the financial system. We are having high cost of capital in India due to persistent current account deficit. See, this is repeated theme. Just let me tell you once again what I have already told in the first video. This is what economic survey is saying. In India, interest rates are high when you compare with the other countries. Interest rates are, it is also called cost of capital. That means if you want money for some loan, how much it is costing you. Cost of capital or interest rates are usually high in India when you compare with other countries. What is the reason for this? Everybody thought our financial system is not developed well. It is not deep enough. So that is the reason. There are not many people who are having savings, not many people who are giving savings. Okay, except banks, nothing else is developing. So that is the reason we are having high interest rates. This is the general belief. And it is true to some extent. Then economic survey this year says, sir, this is only part reason. It is not the full reason. It is not even the main reason. What is the main reason? Sir, this is the main reason. You have imports into the country. You are importing many things into the country. Then you are exporting some things into the country. Exporting some things from the country to the other countries. So when you import, you have to pay US dollars to the person who is selling you the product. When you export, other person will give you and you will get US dollars. We all need foreign currency. Okay? At least to pay all our bills, we need to have foreign currency. So imports are rising. Imports are too much in quantity. We are paying too many dollars. We need to pay too many dollars, but our exports are less. So we are getting less US dollars. For example, I am saying, let's say you have to pay 100,000 US dollars for importing. You need 1,000 US dollars, but your exports is only 600 US dollars. So you have a deficit of $400. Okay, 400 US dollars. This is what we are calling current account deficit. Current account deficit. Okay, include all the services, transfer payment, remittances, everything, etc. Still, you will have some shortage of foreign currency, which we call current account deficit. How we are filling this shortage? You need $400 to pay this. How you are getting this? There is something called capital account. We know there is something called capital account under balance of payment. So under balance of payment, all of this we have seen in the first class also. We have current account, and we have capital account. Capital account. So investments from other countries, loans from other countries come under capital account. So because I need dollars, I have to accept. Many Indian people may be having money, but I don't need Indian rupees, I need US dollars. So I need investment from outside, I need borrowing from outside. Okay, I need money from outside. I have to borrow only from outside, I cannot borrow from inside because I need US dollars. See, if I can borrow from inside, maybe interest rates in India maybe not that much, but I don't have the luxury to take from inside. I need currency, foreign currency, so I have to take investment from outside only. Now what is happening from outside? We know all the foreign investors are very keen on checking every aspect. Now foreign investor is giving me, he is seeing so many aspects, he is so worried. We know foreign investors collect some extra money which is called a risk premium. Risk premium. We know foreign investors ask extra interest rate. An Indian investor may be ready to give for loan for 7% interest rate. Indian investor is ready to give loan to me for 7% interest rate, but I cannot use it, I need dollars. So I need to take loan from foreign person only, and he says, sir, I will give you loan only at 8%. There is no way I am giving you this particular amount for less than 8% because he is seeing some unstable conditions inside India. He is worried about what will happen in the future. So he wants minimum of 8%. This extra 1% he is asking is called a risk premium. That premium he is asking because he is sensing a risk. Now we are buying at higher interest rate from outside. Now the interest rate is higher, so the interest rate is increasing. So general interest rate is the average of all the loans you are taking. You could have taken 7%, but because you don't have enough dollars to pay for your imports, you cannot accept India's extra savings. The only option left is foreign savings, and foreign savings come with extra premium, which is increasing my overall interest rates. Okay, so economic survey says the cost of capital is not just because you do not have proper economic system, proper financial system. Even if you develop your financial system well, even if there are many people who are willing to give the loan, you cannot accept because there is a huge problem of current account deficit here. The only way you have to solve this problem is to export more so that you can also earn $1,000 or more. At least you should cover your import bill. How to promote my exports? The best way is to promote our manufacturing sector. Okay, so this is what economic survey established in the preface itself. Okay, so why there is a high cost of capital in India? Why there is high cost of capital in India? Due to persistent current account deficit. Okay, now let us come to the rural and microfinance. So this is another aspect of the financial system. So not only all larger ones we are talking, banking, capital market, security market. So when we talk about smaller aspects like, so whatever the banks we have, all the bigger institutions, they are mostly focused for urban areas. They are mostly focused on large borrowers. So if somebody is borrowing 5,000 crores, 6,000 crores, bank will give most attention to them. What about common person living in rural areas? So they are not so well included in the traditional financial and traditional banking system. So to give financial services to the common rural person, Government of India have formed something called regional rural banks. Regional rural banks. See, these large banks like take SBI. SBI is throughout India. It is very big. It is too big to focus on the common ordinary person. It has many other interested corporate people. So, because this is too big to focus on common person, we have created a smaller banks called regional rural banks in rural areas. There are almost, so we have created almost 196 regional rural banks across India in various districts, various regions of India. But the problem is now they are growing too many. there are too many regional rural banks and they are failing. They are failing. They are not getting the loans back. They are not recovering their loans properly. So they are suffering with some issues. So what government is doing? Government is doing the problem with the number, and it is too small. It is not able to manage its finances properly. So let us increase the size. Let us reduce the number. So government is merging these RRBs. So from 196, I am not sure of the exact number. So I think it is currently around some 30, 40. Okay. So government is reducing the number of regional rural banks by merging, and the theme is one state, one regional rural bank. So we have 28 states. Almost government intends to reduce from 196 to 28 or some more. Okay. So one state, one RRB. This consolidation is being done because of the issues RRBs are facing. But the problem is, the moment you make RRBs as one, the moment you create one RRB for one state, it is becoming very big, large financial institution. Now that is the problem. That is the very reason we have created RRBs. Because the previous financial institutions are too big to focus on common person. You have created smaller banks, but because smaller banks are having some issues, now the solution you are saying, let's merge them and form a big one. Now you are back to square one. So this move is being criticized right now. For mains, you can see this critical analysis of this one state, one RRB policy of Government of India. Okay, but these are having credit to deposit ratio of 35-year high. So this credit to deposit ratio, that means banks will take deposits, they will give credit. More loans they give, the more profitable they are. So credit to deposit ratio should be higher, always it should be higher. So it is at the 35-year high. So it is good. In a way, we are seeing some good aspects also. Okay, now see the microfinance. What is the problem with microfinance? Microfinance means small finances. Okay, government has formed something called small finance banks also. Again, microfinance focusing on common people, self-help groups, okay, normal street vendors, etc. This is microfinance, giving small amount, 10,000, 5,000, small amounts to the ordinary people is microfinance. But this microfinance is dominated by, again, big NBFCs, okay, big banks, etc. So over the years, initially we started with an intent of welfare, not profits. We wanted ordinary people to get some minimum loans so that their daily life can happen. They can invest in minimum capacities, in minimum shops, etc., like a street vendor, and they will earn something, they will pay back the loan. Our intent is welfare here for creation of microfinance institutions. But over the years, the larger corporates, larger banks, they started these microfinance institutions. Now they are the ones dominating. Almost 71% is from large NBFCs and banks. Only rest 29% are smaller institutions which are not so focused on profit. These larger institutions want more profit. So what they are doing, they are giving maximum loans to maximum number of people. They are saying our reach has increased. But they are not customizing these loans for the poor people. So what we are seeing is profit driven models are increasing instead of welfare driven models. So you can say in RRB and in microfinance, so we are kind of getting little off track. So this is a need, there is a need for introspection here. Okay, that is what our economic survey is highlighting here. Okay. So what are the concerns here in this RRBs and microfinance? So there is over leverage. That means over leveraging means this. Let's say my monthly salary is 50,000. So after all my expenses, I will have some 10,000. So my loan EMI should be 10,000. My loan should be such a way that it matches with my EMI. But what will I do? I will go to bank A, I will take a loan with 10,000 EMI. I will go to bank B, again another loan with another 10,000 EMI. I will go to bank C, again took another loan with again 10,000 EMI. So the loans I have taken is beyond my leveraging capacity. It is beyond my capacity. I have over leveraged, so I will not repay. I am in some need, I have taken the loan, but in future I will not be able to repay. and banks will be in crisis. Okay. So they are over leveraging. So it is one concern. So what is RBI doing? RBI is putting indebtedness caps. Indebtedness caps means how much amount this RRBs can give. Okay, there is a cap limit. You cannot give 10,000 to, you cannot give a loan with EMI more than 10,000 to a person who is earning 50,000. Okay, so there are some limits RBI is putting. Okay, and it is strengthening some guidelines, etc. Okay, self-regulating guidelines, etc. Now securing the future pension and insurance. So pension sector and insurance sector are also part of financial system, because see what is pension system. I am an employee, any kind of person working in private or government. I can work till only certain age, which is usually seen as 60 years retirement age. So after 60 years I need some financial security. So what will I do? I will save some money every year. Every year I will save some money, so that in future I can get this as pension. So there are some, let's say I am a government employee. What will government do? My company will take some amount from my salary every month. So it will keep on depositing with the government every month. When will I receive? At retirement, as pension every month I will receive this money. This is how pension system works. But what will happen in this between years? Let's say I am 30 years now, my retirement is 60 years. So for the next 30 years, every month I will be paying some amount, but government will give me this money back at the end of 30 years. So what will happen to this money for this 30 years? Now come to the insurance. So I will pay insurance. Let's say I want some insurance towards my end of the life. If I had something will happen to me at my death, I want some amount to my family. So again I am paying this insurance money for the next 30 years, so that if something happens at the end of my life, my family will receive some money. So in between years I am only repaying. Only when something happens or the policy gets expired or it meets at the end term, that insurance company will pay back. So what will insurance company will do this money for the next 30 years or 15 years or 20 years? In both cases, pension or insurances, all the money they are collecting, they will invest in the financial system, because financial system grows. If I invest in something, it will give me returns. So these companies, they will invest, they will get returns, some of that amount they will give back as pensions and insurance amounts. Okay, so this is how pension and insurance system works. Now this investment from the pension money in the financial system is called assets, pension assets. So the penetration, the pension asset is currently only at the 17% of the GDP, very low compared to the other countries OECD. So it is very high, 70-80% in these countries, but in our country it is very low, 17%. Okay. So the penetration of pension sector should be very high. There is more room to improve. Then pension, only pension sector I am talking about. There are some good development also. There is something called NPS. Okay. If you don't know this debate of pension system, old pension system, as a current affair only I am telling you. New pension system, then there is unified pension system. Okay, please go and read. Okay, there is some debate about recent government pension policies. So this is a different topic I am just giving you. So I am talking about new pension system. Under this new pension system, government has introduced two schemes. One is NPS Vatsalya for the minors. So if I want to open some pension scheme in the name of the minor, I can opt NPS Vatsalya. Then now gig workers also can participate in pension system. They also can pay some amount. Gig worker means Swiggy, Zomato, Zepto. So if I am a Swiggy delivery boy, every month I can deposit some amount under the scheme with the government. Government will give back pension after my retirement, after my 60 years. Okay. So NPS is Shramik. Now insurance penetration is very low. So out of the total population, only 3.7% are taking. Out of all the Indians, only 3.7% Indians have insurance. So that is very low. Everyone should have insurance. Okay. So because insurance is low, very low, now what is government doing? Government has recently brought a new act. You can see here, this is a current affair. Okay. So government has brought a new act which is Sabka Bima, Sabka Raksha. Okay, new insurance bill. Okay, now it has become an act. So under this act, there is 100% FDI. That means any foreign person, because all the insurance companies of India, they are not able to properly penetrate into people. They are not able to promote insurance into people. So now they are asking even foreign insurance companies to come and invest in India, establish new companies. You don't have to take government permission, etc. You can automatically start, no limits. You don't have to you don't have to partner with an Indian. 100% you can do, and all the profits are yours. Why? To promote insurance. Okay. So our goal here is to expand the safety net for an aging population. Population, as we develop, we have our aging population will increase. So one point I want to add here is that in a securities market also. So in securities market also, right now securities market is governed by, it is regulated by SEBI. Okay, there is a Securities and Exchange Board of India. So SEBI was formed under SEBI Act. Okay, there is a SEBI Act, I think 1992. Then there are many acts. Okay, Depositories Act. Okay, there are security definition. There is another act from which definition of securities comes. So there are 3-4 acts currently regulating the securities market. Now it is updated because now the technology is everywhere. Now artificial intelligence is everywhere. New kinds of algorithm is coming on. Speculations going on. Now there were some, last year there was an issue about SEBI chief also. So transparency of SEBI chief, etc. Many guidelines given by SEBI became controversial. That is why regulatory refining we are talking about. We have seen in the titles, right? Regulatory refinement. SEBI has done some things which have given adverse effect on the market. There, it is the subjective decisions taken by the people in power inside the SEBI have not given good results. So now we are moving to principle based governance, set rules, not subjective based on governance. So government is also bringing new act here. Okay, called Securities Market Code, etc. Okay, there is a Securities Market Code, Securities Market Code Bill. It was introduced in Lok Sabha in December 2025, I think. It is still have to get approved. So 2025 December. So there is a new law coming in securities market also. Okay. So we are reforming security market. So we are reforming RRBs. We are consolidating under one state, one RRB policy. Then we have brought a new act in the insurance sector. Okay. Now we have seen our financial system. Now what about integration of our financial system with the rest of the world? Okay. For this integration, we need this international financial service centers like GIFT City. Okay. So we know domestic institutional investors now more than foreign institutional investors. We have already seen. So it is a good thing. Less dependence on other countries is a good thing. Now India is less vulnerable to global risks because now we are more dependent on domestic investors, not international investors. Okay. So here we can see International Financial Center of India ranking 43rd. It is recently established. We will keep on improving. Okay. There are many innovations happening in this region. Okay. So this is about the GIFT City. You can read the facts. Now what is RBI doing? Now what is RBI doing? To cover the deficiencies in our financial system. So after COVID there is very high inflation. So RBI has increased the interest rates. Now COVID has gone. Now all the countries across the world are lowering their capital. We already know there is the cost of capital in India is high. Interest rates are high. So what RBI is doing? Till now we have tightened the money supply. Till now we have tightened the interest rates. We have kept interest rates high so that people will take less loans and there is less money in the economy. Okay, because immediately after during the COVID, government has pumped so much money into the economy. Government has given so many things to the people. Now the inflation is high. Now RBI in the past few years has tried to tighten and reduce the money supply. It used its monetary policy tools, repo rate, reverse repo rate, etc. Now it is time to increase the money supply in the economy. So RBI has reduced the repo rate. So from 6.25 it has reduced to 5.25. Okay, 1% means 100 basis point. Okay, 1% means 100 basis points. We have reduced the repo rate from 6.25 to 5.25. Okay, and if you read the static portion, there are some requirements like in the money and banking you will read banks have to keep some amount with the RBI like cash reserve ratio, CRR, SLR, etc. So there is different kinds of requirements. Monies banks have to keep with the RBI, and usually this cash reserve ratio, which is the amount banks have to keep in the form of cash with RBI. Usually the CRR is 4%. Now it was reduced to 3%. Okay, CRR is reduced to 3%. So all the measures, RBI has cut the interest rate. When RBI cuts the interest rates, now the repo rate is the interest rate RBI is giving loans to the banks. So if RBI is giving to banks at a lesser interest rate, banks also has to give to the people at a lesser interest rate. So the interest rate should be transmitted to the cut in the rates. The lower interest rate should be transmitted from RBI to banks and banks to customers. So that is happening. Economic services, yes, banks are also reducing the interest rate. So RBI, whatever you are doing for the common man, it is working. Okay. And we know now technology is everywhere, AI is everywhere, and we have seen AI is a double-edged sword. Now AI will have benefits and disadvantages. We have seen what are the negative consequences of AI. So to regulate AI in the financial system, RBI has came up with something called free AI framework. Okay, free AI framework. So RBI has set some parameters, 7 sutras, 7 rules, how there should be trust in the system, fairness, etc. So read about a free AI framework of RBI. Okay, it can be important for prelims and mains. So free AI framework is related to what? It is related to RBI. Okay, to balance AI innovation with the financial stability. So these are the measures RBI is taking for betterment of our financial system. So we have seen the financial, monetary management and regulatory fine tuning chapter of this chapter 3. So if I have to summarize entire thing, so India's strength from post crisis era, now India has came to a growth ready architecture. We are improving in so many aspects. Our credit growth is increasing, banks have improved, RRB's credit is increasing. So there are some good aspects. We have some strengths like our financial market is deepening, banks have clear balance sheets, our digital infrastructure like UPI, okay, JAM, okay, JAM Trinity, Jandan, Aadhaar, okay, mobile are increasing. We are consolidating RRBs. So there are some strengths for us, but at the same time there are some concerns like there is high volatility across the globe. Okay, technology is increasing rapidly and it is also resulting in some negative consequences. Our corporate bond market depth is not enough. Our pension penetration is not enough. Okay, our insurance penetration is also not enough. Okay, so this is about the summary of the chapter 3. Okay, so let us end here. In our next session we will see the next chapter. Thank you.